I don't put it out. But you got one this morning, Charlie. You got one this morning.
I'm going to have to go back and review.
That's right. That's right. Very important work this morning, Charlie.
More important than the conference
No
call.
distractions, though, with that shirt.
Wells Fargo is starting a conference call right now, but I think the big one was JP Morgan.
Right.
Wells Fargo. My KRE 50 puts are dead, by the way. Those are going to be zeros.
Yeah, I'm glad I didn't short any of it going into this, but maybe I should do it now. That's all. I just decided to wait. But it sounds like banking is strong for both Wells Fargo and JP Morgan.
I'm down $1 or something, I think, or flat.
Yeah.
How much? There.
It was funny. Wells Fargo was talking about a solid consumer, and then JP Morgan was talking about higher loan losses from credit cards. So I guess give and take on subprime customers depleting balances who are not fighting inflation well versus maybe rich people. So I think it maybe gets to, we'll have to hear from Charlie. Is it a mixed thing? What's going on?
Yeah. I'm all set.
You ready? You locked and loaded? You're going to go
I'm
first?
locked and loaded.
We have an order?
No one's locked and loaded as Marcin with that shirt, man.
Yeah.
I know. It sets the tone. Really sets the stage. He's the boss today.
Really should have a Philadelphia Eagles jersey on.
Hey, Dean, you didn't hear this. Gritty the mascot is an asshole. He really does offensive things in his pants. But he's a charming asshole like me.
Okay. All right. I know a few of those people.
I let you down this morning, Robert.
We don't have secrets right now, so I didn't get in trouble with that.
But no, you're not
Define a charming asshole.
Well, someone who says assholish things in a way that makes you not get upset at them, the receiving party.
Okay.
I did an interview with the CEO of Sargon a couple of months ago, and he said, we came to Philly 3 months ago, and you beat me with a stick during our presentation.
Where did you get that, Nadine?
He said,
my friend.
I'm making a point here. He said,
You want one, Charlie?
Yeah.
I won't.
It's a good friendship bracelet.
The best part is that the colors are so happy, right? They're amazing. You missed that, maybe. Here we go. All right. Anyways, it's 7:01. I think we get rolling. It's Friday. We got a lot of stuff to do. Earnings going on. Friday, October 11th, 2024. I'm Nadine Turman. We're on Wall Street Beats. Today we have, luckily, he's hopping in, Charlie, the Steve Jobs lookalike Peabody. We've got Ben Bry with a relative value trade idea, Paul Meeks talking to us about the cyber suck event that happened yesterday, and Robert Marcin flying high with his chart. Bob Morris is supposed to be on. I don't see Bob, but anyways, don't see Steve either. But if they hop on, we'll see him. Otherwise, I think we have enough heft here to cover the show and more. We're going to kick it off with Charlie. JP Morgan's been out this morning, Wells Fargo, another bank, and let us know what should we be focused on, what mattered and what they said, other than, where was that note? I put cash is a very valuable asset.
Yeah.
That was the quote.
Yeah, so Jamie Dimon was channeling his inner Warren Buffett today, and even said that he believes cash is king, and that capital should be conserved, for some future events. So he was expressing a lot of caution about asset values, yes, about balance sheets, and unexpected events. So I thought it was important to highlight,
Is he talking about loan losses? What is he talking about here that he needs cash?
Well, he thinks that there's still a risk of higher rates. He thinks the geopolitical events haven't been discounted. And so he's husbanding his capital. Now, when I say husbanding his capital, he still bought back $6 billion worth of stock during the quarter.
Sure.
So, but he did say, I think stocks are overvalued, and he doesn't want to buy too much stock up at these levels. But they reported earnings, $4.37 was honestly exactly what I had predicted. I was above the street. The street was at $4. So, it was a beat and raise in terms of revenues and expenses and earnings. But what they did guide towards, and I mentioned this on yesterday's call, was the idea that net interest income would continue to decline sequentially into the middle of next year, and that expenses would continue to climb as they invested in the franchise for the future. So, estimates for next year are probably going to be around $17, down from $17.70 this year. So, stocks up 9 or 10 points this morning. I'm a
Yeah.
seller into this rally, just because I think the next couple of quarters could show sequential declines in earnings.
Okay.
Wells Fargo is on right now. I haven't listened yet, but that's the one I would have bought, ahead of earnings today.
Yeah. Right. And for Wells Fargo, I mean, I saw a little bit about it, but they were talking about the consumer spend is solid, but then you get to JP Morgan and, deposited balances shrank. They said that there's going to be higher loan losses from credit cards. That doesn't jive with the solid consumer thesis. So is this the fact that, not all consumers are the same? So subprime folks are maybe depleting their balances, not fighting inflation very well? Or how can, maybe parse for us the commentary from the banks out there, and what's your takeaway on the consumer?
Yeah, so the Wells Fargo conference call is going on right now, and so I haven't had a chance to listen to the color there, but I think what you're getting.
You can't do 2 things at once?
I'm sorry?
You can't do 2 things at once?
I'm lucky if I can do one thing at once. But no, the revolving balance growth is outstripping spending, which tells you that some consumers are having to, use their cards to get from paycheck to paycheck. Now, the banks tend to market towards the upper end of the consumer spectrum. The credit quality there still is what they call normalizing, and that has a benign connotation. But we're at that point where we're going to cross. If credit continues to deteriorate from here, we're going to cross from normalizing to deteriorating, and that means you go from a benign, implication to a negative implication. And we'll see, because right now credit is very manageable for the big banks. And I do think, if we have a credit cycle ahead of us, the big banks are going to manage that fairly well. I'm more worried about the non-banks, the monoline credit card companies, the monoline auto finance companies, the private credit, private equity companies. I think that's where the risks are being taken right now.
Okay. And so if you were going to be shorting into these good prints, where would you be telling people to short?
Well, you had a mixed NII outcome today, where JP Morgan beat, Wells Fargo missed. The difference is that JP Morgan is saying we think sequentially NII is going to continue to decline, and Wells Fargo, I think, is highlighting an inflection point here, which is why I wanted to buy Wells Fargo ahead of the print yesterday. Right. So it's going to be hard to to say generally what the read-through is for the regional banks. I think it's going to be case by case. I'm a buyer of M&T and Citizens Financial. I'm a seller of PNC on the regional banks.
Okay, thank you.
I'll leave it there. Go ahead. Sorry.
Anything else? Anything else what you're picking up here?
The investment banking, had a strong finish in September. So there's the possibility of surprises there. I mentioned yesterday that I was short Goldman Sachs going into the print. The one number that they did not give guidance on in September was investment banking. But if the read-through from JP Morgan is that investment banking is strong, then Goldman could surprise. But I'm still expecting a disappointment out of Goldman Sachs.
Okay. Paul, you got a question?
Yeah. As pertains to Wells Fargo, right? I know the call's going on now. You're not on it. And maybe they don't say so anyway. Do you still believe that the Fed is going to get rid of this asset cap sometime in 2025?
I do. And that obviously is going to be the focus of the call that's going on now. They've got about 6 or 7 consent orders outstanding right now. I would say over half of them relate to their mortgage banking operation. They started to deal with those shortfalls in mortgage banking in the fall of 23. So by the middle of 25, they'll be 2 years into it. I think once they can get those resolved, then the Fed's in a good place to remove the asset cap. And that's the other reason is if we have an inflection point on NII for Wells Fargo here in the third quarter, and they can start growing their balance sheet by the middle of next year, then we've got a real strong upside in top line revenues for Wells Fargo, and that's what I'm buying into, the release of that asset cap and the growth in NII. In the meantime, they're still buying back $3.5 billion of stock this quarter, which is about 5-6% of their shares outstanding on an annualized basis. So it's a good situation.
Nice. So now I'm going to head over to Ben. Ben, I know you've got this SPY versus Q's relative value trade. Walk it through with us. I know you got some charts to share as well.
Walk it up, walk it down. Let's Friday. Let's get it going.
Walk it over.
Do the robot dance like the robots last night. I know we got Paul coming in at the end to do that. Yeah, this was something that was brought to my attention by Nadine and I had a podcast earlier this week that will come out this weekend with Hugh Hendry, and he was talking about this ratio of the NASDAQ to the SPY, and so I started digging into it a bit. And what, if you notice, since July 10th, when the yen weakness peaked, and you could call it the carry peak, if you will, the top of the market has actually been a giant drag on the market. And
Sure.
So we've had the broadening. I mean, if you guys remember June and May, all anyone could talk about was, it's the most concentrated market and nothing works except for the Mag 7. Well, we've kind of gone in reverse of that. And this chart right here, the white line is the NASDAQ divided by the SPX. And you can kind of see we stalled out. And we stalled out right where we stalled out in 2021, 2020, in that kind of bubbly period as well. And, the relative ratio of valuations, trailing 12-month PEs are 35, 36 times for the NASDAQ and like 24, 25 times for the S&P. And obviously that because it includes energy and includes financials, which you're not going to have as much. But look,
Sure.
This morning, financials seem to be trading pretty well. And the last week or so, as Robert Marson and I are happy about, energy's been trading well. So one of the themes of 2000 to 2002 was a broadening out of the market. And so one of the things you could do, in my thinking now, is if the top of the market is so big, I mean, literally the Mag 7 is $16 trillion as of yesterday's close. Yeah. And it's lost $1 trillion of collateral value since July 10th, right? That's a lot. But having said that, the S&P is up $1.4 trillion. So that other 493, and even within the top 30, because I looked at every stock in the top 30, their PE and what they've done this year and what they've done since July 10th. And a lot of it's broadened out to other names. And so it's really like, if you look at that, the top of the market is now hurting the performance of the SPY. And so if that's the case, you can run this position and make money. Since July 10th, the NASDAQ divided by the SPY pair is actually down 5%. So you're already making money. And you could be in a situation where if the market falls out, this will drop because so much market cap sits in that top of the market, which is so over indexed on the NASDAQ side. And if not, you don't make much money. You kind of sit there and it goes as it goes. But you also could just do what we're doing now, and you just have a little bit of outperformance from banks and from energy and from other value names starting to distribute. Because remember, when we talk about the actual numbers, which I think is important, the top 30 stocks are $27 trillion market cap, and the bottom 470 is little under 24 trillion. So you don't really need that much. If you take out, let's just say, 6 trillion and add it over, well, that's a 25% move in the other 470 and a fairly, what is that, about 15% down in that top bucket. And so that NASDAQ divided by SPY should probably return you about 10% on that. Now, this is also a trade, like almost all relative value trades, where you can use leverage because it's a market neutral trade. Now, it's not, there's basis risk, which is I'm advocating to take the basis risk here.
Right.
But again, you're not going to have that market beta, basically, that you would, in just a directional position. Yeah. So you can use 2 or 3 times leverage pretty easily. So a 5 to 10% move is actually a fairly big trade. So it's kind of interesting. I'm going to do a little more work on it and compare it to a couple other things. But I think, it's something to keep an eye on here, because if you're just a directional bull, this is kind of a good thing in essence. I mean, we've seen other stocks get pick up the slack. But this is a way to maybe play some of the reallocation, if you will. And one
So let's
final
say somebody
thing,
puts this trade on, but let's say somebody puts this trade on, Ben. They're long the SPY, short the Qs. You know, how do they gauge when to stop, right? When that relative value trade can end. You know, how should somebody be managing this position once they put it on, if they chose to do so?
well, my guess is that, or not my guess, my thinking is there's no direct level, but I
Yeah.
think you'll know when the multiples compress. Like I have a chart that I didn't, it's not on here, but like I have the relative PEs of the Qs and the SPYs, and it oscillates between 1.3 and 1.6, the relative of the two of them. And so, you know, if you get that 1.2, if you can get that down like more towards the lower end of the range, you'll probably feel a little better about that. But you know, it's not that simple. You know, it's where is the money flowing? Are guys
Right.
going to be allocating to the rest? What's the dollar doing is going to have a big impact on it as well. And what's the election going to be? So the election is, Kamala is very probably good for the Mag 7. I think Trump's probably very good for the other 493, if you will.
Right. Okay. So would you be putting this trade on now before the election, given that's more of a open the envelope event, or are you getting people to do work now so that they're going to put on that trade after? How should they think about that type of thing where you don't know the outcome?
Well, I think it's good to do the work yourself, but as you know, I have a bunch of Trump trades on. So if this is just another Trump trade, very happy to add it to the basket of Trump trades. If you're talking about pre-election risk, but I think that I don't think that it totally matters. I think that when one of the things I put on the chat and I've talked about, 43% of the S&P's market cap is under antitrust lawsuits right now. All right, so these guys have consolidated to a level that they're just duopolies, monopolies. You know, we're talking about Standard Oiling Google, which would be great for us. Then we got a YouTube stock and a Waymo stock, and we got search stock, and you know, for the market, it would be a great thing the way they did Ma Bell and these things, and you got more stocks and you have more competition and all this. But I just think that risk is not necessarily going away under either guy. Like I think there's a movement here towards, you know, kind of breaking some of these monopolies and duopolies up and trying to, you know, maybe make the system a little more fair. They have such a competitive advantage. They're such dominant businesses that we haven't seen since the Gilded Age, in essence, back in the days of Vanderbilt and Rockefeller. That, you know, I think that that's a play on that as well.
Okay. Well, thanks. Now we're going to go over to the CyberSuck event with Paul Meeks. Paul, were you watching it? You know, are you excited about that? What's going to happen? When's it going to happen? I wrote about it this morning. It's like, I don't know, it just seems like one more thing with a bad song.
Yeah, I was indeed watching it. I wasn't there in person, but I was following the event last night. So one of the things that's happened here is the first time they announced they're going to do this event was last April. And the stock, no surprise, even though they postponed the event all the way until October, the stock had a huge run. It's up about 70%. Now it's given up the ghost a little bit today, but you know, this is a vision that Musk has been talking about since 2015, 2016. And self-admitted, he always says, you know, my timelines are, you know, very aggressive, very optimistic.
Sure. Yeah.
And so his latest timeline is 2027, and I agree, very optimistic. And in the meantime, you know, they're probably for the first time in their history seeing a salt in the EV business, right? There's frankly other competitors out there in the U.S., particularly abroad, that are actually doing it better.
Doing a great job. Yeah.
Yeah. And so all these things are shiny objects, I think, to get investors to focus on the latest and greatest, you know, the robo-taxi and also the robots, and to mask some deterioration in the EV business, which is mature and they're losing some share. So I still think the stock is a better sail in here. We'll see what happens. But this year, their EPS is going to drop by about 50%. And next year, their EPS is supposed to climb back to a level of 22 or 2023. So I don't know, not such great shakes. So yeah, I've always in the Mag 7 been uber cautious, no pun intended, on Tesla.
And what's the expectation here when you see the shareholders and what they're expecting out of this security? I mean, are they still in it for this, or given the fact that it had a huge run up? And I mean, today it's down, but it's not down that much. What are people believing? Are they, because are they not believing the numbers, and therefore you have to really figure out what they are believing, or are all these people really betting on that improvement next year?
I think they're betting on the improvement, and also, Musk himself will tell you if you're interested in a EV stock, don't buy us. If you don't think that we're going to solve autonomous driving, don't buy us. So everybody, I think, has transitioned into the stock now, believe in those things, that they talked about last night versus the mature business. But of course, if it's a mature business, they want to distract you away from that. Sure. But in the interim, and for probably many years, I'm thinking through the end of this decade, that's still going to be what brings them to the dance.
Right.
So I'm worried about it. Yeah. And I think it could go down more, right? Because it before it went down 8% today, it went up 70% since last spring, even though it's still down in 2024 year to date.
Right. Well, thank you for that update.
Paul, it looked like the coolest thing from the event was the robots.
Yeah, pretty cool. They were making drinks and they were dancing, baby.
Kind of dancing. I mean, what do people expect out of that? I mean, there's a lot of robots who actually do things in this world. So is that just for fun and people get excited about the fun element, or did you see anything useful coming out of that?
Yeah, of course. I think what they're presenting is something more sophisticated than you've seen, particularly in manufacturing and warehouses. But still, I don't know if it's that much over the top that gives you any inkling to think that they're going to have this market to themselves.
All right. Well, thank you. We're going to head back over to Robert Marson. I know you're flying high with your shirt and thank you, Paul. Thank you. Nobody else is listening. And your stock today. So walk us through what you're looking at and how you're going to play it.
Well, spoiler alert, this is the pun was this is the Flyers hockey team mascot. So yes.
Yeah, you listened too. So I got 2 out of 4 listening. Thank you.
Begin their season today. But I'm going to talk about something that is cooler by design. That's Chart Industries' slogan. And $25. I'm giving you an update on that today because a couple of things happened last week that I thought were noteworthy. First of all, the company, from the good perspective, announced a large LNG project selection by Exxon of their technology. And everyone thinks of LNG, liquefied natural gas, which is a fuel that's going to be around perhaps a lot longer than oil, at least in a supply-demand basis for the next 20 or 30 years, because we still need it as primary power in a lot of different applications around the world. It's much better than coal. So I'll take it if China goes to takes a lot of LNG and starts reducing their coal-fired plants. But the company won this award from Exxon. It was formally announced. Small and mid-sized modular LNG plants. Compressors and generators and pumps and these, and you have to do massive structures and big ports, and these guys have a modular product that has gotten a lot of small and mid-sized orders, but not many big orders yet. And this is a very large plant, so it's just good that Exxon picked this technology to use, because it's an endorsement of a technology that needs to gain market share in the bigger LNG plants, and that was a big positive. The negative.
So I see a huge short interest on this. What's the short thesis, and is that getting blown up now, or maybe walk us through why are people betting against this name?
very, very good question and a very good point. And it comes to my negative aspect that I wanted to talk about. The bad news is that the company started. It appears there was 3 or 4 estimate cuts and price target cuts in the last week at the beginning of the new quarter. So that tells me the numbers are going to be a little light, and the street and Wall Street is being managed down by the company. Okay. Now it's not a slash. That happened last quarter. They slashed numbers last quarter. This quarter is more of a light trim, but they are trimming the numbers. The company seems to have said the back half of 2024 is about what we thought, but it's going to be heavily back end loaded for the fourth quarter. So the third quarter is going to be a little light. The fourth quarter is going to pick it up. But you got to remember, this stock on that slash last quarter dropped from 170 to $109, where
I saw 101 too. I saw it was low as 101 at one point.
Well,
So
it went to 109, where I did a piece on it and bought it, and then it rallied to 125, and then when oil dropped to $67, it dropped to 101, 102 for a day, and now it's back to 125. So it's been a disappointing stock. When I get my last big negative estimate revision for a stock that's very, very cheap and down and oversold that much, I don't normally make 10% or 8%. This stock should be 140 today. And if they weren't cutting estimates, it would probably be $140. So is
this a buy now, or are we waiting for more shoes to drop before you're getting in?
Well, I think the CEO, her name is Jill Ivanko. I think her favorite song is Britney Spears' "Oops, I Did It Again," because she keeps doing it. So you would think a CEO that you can't keep cutting earnings estimates quarter after quarter. At one point, you figure it to bleep out and you cut the numbers so that your grandmother can make the numbers. I mean, this is ridiculous. But the value is, and the growth and the business is still compelling. When I'm going to say they're going to grow 10 to 15% for the next 3 years organically, and they're trading at 7 times EV to EBITDA. So the risk is in the balance sheet cash flow. They need to pay down $1 billion in debt over the next 2 years, $500 million a year, to get the balance sheet to be safer and to remove the hanging over the company's stock because of the leverage. So yes, that's why people think they're missing numbers, which they are, and people are worried about the balance sheet, and the balance sheet needs to be fixed. And if they fix the balance sheet in a year, the stock should be 20, 30, 40% higher if we're not in a recession.
So you're saying that it could be toxic, but you're going to give me more time on this. And baby, one more time, can you come on the show and update us on this stock?
I'm not saying it's toxic. It's the debt's 3.2.
Did you get that? Did you get that? Any Britney Spears fans? Anyways.
Paul
did. No one else is watching. All right.
They did $4 billion in debt with a deal. They've paid $1 billion down. They need to pay another $1 billion down. And at that point, the balance sheet becomes a non-issue. But for right now, it's the levered way to play energy on the short side, because they have a balance sheet that is definitely over levered, by $1 billion or so in the short run.
Perfect. Well, thank you so much for joining us today. It's Friday, October 11th. We'll give you a good weekend, and then we'll catch you back on Monday with the team. Thank you.
Thank you.
Well,
I'll see you guys. Have a good weekend.
Bye.
Bye-bye.